what we're looking at here is the red herring fallacy. It's a literary device. A lot of you are probably familiar with it. It's an argument that's meant to distract you from the real issue. And I did a little bit of reading about the red herring recently. And interestingly enough, you can trace the first use of the phrase red herring to describe a distraction to this guy, a early 19th century. He's described as a radical journalist from England named William Cobbett, who first used the term red herring to describe a distraction in description of a story where the defeat of Napoleon was falsely reported in English news in 1807. And it turns out that story was traced back to Napoleon's spies who had planted misinformation. It was really one of the earliest uses of fake news, if you will. And some fun facts about this guy, William Cobbett. As I was reading about him, he was a big proponent of the gold standard, which kind of resonated with me. He was radically opposed to Malthusianism, this belief that we need fewer people in order to prevent starvation and save the planet. It's kind of a line of thinking that's gaining popularity among the elites these days. He was also a big proponent of less government waste and lower taxes. So this guy, I was kind of digging this guy, although later on, Karl Marx kind of latched onto his work and his early writings of communism. So it wasn't all unicorns and rainbows here. But I found it pretty interesting. And the origin of the phrase red herring is actually, there's no such thing as a red herring. It's actually referring to this stuff, which are Scottish kippers, which is this very pungent smoked herring fish. And, you know, it gets the name red because it's been sliced open at the belly. And they were used to train bloodhounds, train hunting dogs. And what William Cobbett used to do when he was a kid is to throw off the dogs in order to protect rabbits that he liked or things like that. He would drag one of these kippers or one of these red herrings through the woods to throw the dog's scent off. So that's the origin of the phrase, the red herring. It goes back to 1807. I thought that was kind of interesting. But we actually have a new breed of herring here. All right. And it's a newly discovered fish, and it is Herringus magatus, as you're looking at right here, or as I call it, the orange herring is what's being used now to distract everybody from what is going on in the world. We obviously had a big news in this subject this week, but I don't want to talk about that right now because, as always, when the magician is doing something with the left hand, you want to watch what he's doing with the right hand. And there was some things that were dropped in the news this week that, stand alone, any one of these maybe wasn't a really big story, but when you put them together, it's actually really scary. And that is what's going on with our pensions. And I think what's going on with this circus in the press is really meant to distract us from the fact that we are all being robbed blind in the form of our retirements. And that's what I want to show you here. And it started with this article on May 28th. It came out this week, just a few days ago. Slow moving property crisis means averting a greater one. Now, there's this phrase, extend and pretend, is going on in the market right now. Everybody's like, we all know commercial real estate is collapsing, right? We've all seen these stories of the buildings losing hundreds of millions of dollars. And yet we don't see banks failing from this. And we don't see these big financial firms going under. How could this be possible? How could we have this massive property crisis going on with all of these buildings and all of these skylines losing value, and yet it doesn't show up in the system? And for that, before we do that, I want to cue up my buddy Travis here. He's going to play a video for you guys from the movie The Big Short. And in this phone call, Christian Bale, in this first phone call in the movie, Christian Bale is talking to Goldman Sachs, and he's saying, look, guys, mortgage defaults are on the rise. How come my credit default swaps, my insurance on those mortgages aren't going up in value? The banks are lying about what these things are worth. So let's roll that video here.
You can't call me back for a week?
I'm so sorry, Mike. Goldman had a systems failure. I lost a ton of messages.
Yeah, B of A said they had a power outage. Morgan Stanley said their server crashed.
Huh. That's weird.
Well, I would call it improbable. So, where do you have our position marked?
I think it's the same, Mike.
What? Can you explain that to me, please? Because how can the value of an insurance contract not be affected by the demise of the very thing it insures?
They're independent markets. They're not always correlated. I know it sounds odd, but these are very complicated products.
So what happened in that story is, first of all, he calls Goldman Sachs. They don't return his call for a week. The banks are ducking him. All right, because the banks are lying. They know these credit default swaps should be worth more money. They know mortgages are dropping in value like crazy. The banks are pretending that it's not happening because the banks have all of this toxic crap on their own books. And it's not in their interests to actually mark these things to market in other words, tell the world what these things are actually worth. And of course, Michael Burry, portrayed by Christian Bale, is just beside himself at how fraudulent and how just BS this is. And so I want to talk about this slow moving property crisis. And, this is an article like so many articles talking about commercial real estate where they're saying, oh, the bottom is in. Every time you read about commercial real estate, there's one guy quoted saying, don't worry, this is the worst of it. But they've been saying it for a year as it continues to get worse. But there was one line in this article on May 28th that really jumped out at me. And I want to zoom about halfway down in this article. And they're talking about how there's suddenly more of an appetite for these commercial mortgage backed securities, these bonds that are made up of loans to office buildings and apartment buildings and retail buildings. And in this line, they're saying this year through late April, investors scooped up $24.6 billion of CMBS offerings, 170% more than the same period last year. So this stuff is selling like hotcakes, even though these buildings are losing hundreds of millions of dollars every time they sell. Investors are buying up these bonds for some reason. And then they go on, and this is what really spooked me. They said this is allowing the banking system to offload some of its real estate risk to investors. Now, that right there is what really scared me about this, because you can't eliminate risk. All right. My buddy Joe Brown over at Heresy Financial, he says this all the time. Risk can't be eliminated. It can only be transferred. And so what they're saying here is all of these commercial mortgage-backed securities are selling 170% more than last year. So it's almost tripled. And at the same time, they're saying the banks are offloading real estate risk to investors. Now, who are those investors? You might be shocked to learn that those investors are you. You are those investors. We're not talking about Wall Street firms that are buying this garbage. It's you that is buying this garbage. While you're being distracted by the orange herring and everything going on in politics, your nest egg, your pension, your 401k, your IRA, which whether you realize it or not is heavily invested in this kind of stuff, these funds are buying up commercial mortgage-backed securities from the banks. The banks, which are not marking them to market, they're not saying what these things are really worth. They're selling them to you. And you get a little bit of detail on that in this article that was in the Wall Street Journal just 2 days ago. Commercial property meltdown clobbers pension funds. Now, just look at the difference in the titles here, right? Where a few days ago, they're saying slow moving property crisis averts a greater property crisis. And then a few days later, they're saying commercial property meltdown clobbers pension funds. What a different tone the titles have taken here. Government retirement funds are selling property at a loss as the slump spreads. So while they're saying it's good that the banks are moving slow and offloading that risk to investors, the investors are getting clobbered in this stuff. In other words, they're socializing the losses to you. Government pension plans are getting hit by the commercial real estate meltdown, and many fear the bleeding is far from over. Canada's national pension plan said in May that it's selling stakes in the Manhattan and San Francisco office towers for $225 million less than it paid for them in April. California's government worker pension plan said it had unloaded a Sacramento property it had been trying to develop for almost 2 decades. In March, consultants warned that teachers' pension plans in California that the office holdings would continue to drag down their returns. This is offering a new glimpse into the widespread and slow-moving commercial real estate slump. They misspelled crash there, because those investments generally don't trade on public markets like stocks. There isn't an agreed-upon price. That's a key phrase there. They don't trade like stocks in public markets, and there's no agreed-upon price. So the banks can just basically say these are worth whatever we say they're worth. Of course, nobody's willing to buy them for that unless, of course, they're not buying with their own money, i.e. pension fund managers, private equity managers who are managing your retirements. Now, 2 years after rates started rising and 4 years after COVID, The impact of these events is spreading from U.S. banks with trillions of dollars in property loans and investments on their books to the retirement savings of teachers and firefighters. Exactly what they said in the last article. The banks are dumping this toxic sludge into your retirement. And there's stories after stories here going on with just telling stories about all of the losses taking place in these office buildings. Let me just give you a couple of examples here. Where is it? Give me 1 minute, guys. I have to find my notes here. Invention, the Canada Pension Investment Board said in a report that it had sold its stake in a downtown San Francisco office tower that once housed Uber Technologies for $44 million. CPPIB bought that stake in 2014 for $219 million. And the fund said it signed an agreement in March to sell its stake in a building at 10 East 53rd Street in Manhattan for $7 million after buying it in 2012 for $57 million. So just those two stories there about this Canada Pension Plan Investment Board, the CPPIB, they have lost $225 million on these two deals, an 82% loss on these buildings. And that's just one of the stories in here. All right. There's another one talking about this California pension plan. All right. The $493 billion California Public Employees Retirement System, or CalPERS. All right. They just took a 12% loss on this building in 7th Avenue in I think this was in San Francisco. All right. A more modest loss at 12%. But you're talking about pension funds that are tragically underfunded. And now they're taking these massive losses. They're talking about one property in particular here. In early 2000s, CalPERS bought this they bought this parcel of land, and they were going to build these two 53-story condo towers on this block in San Francisco. A decade later, CalPERS approved a different plan on the site. They were going to build an office condominium retail complex. It was going to be Sacramento's largest tower, but of course, not enough office tenants were ever found, and so they had to scrap those plans. In total, CalPERS invested $87 million on this plot. Then in April of this year, the pension fund said it had sold the land for $17 million to the Shingle Springs Band of the Miwok Indians of Placerville, California, a federally recognized tribe. So CalPERS took a $70 million loss on this plot out of an $87 million investment. That's an 80% loss. So, I mean, you can see here in these stories, these pension funds are getting destroyed in commercial real estate while the banks are selling more and more of this stuff into pension funds. They're using your retirement as exit liquidity. You're holding the bags, and the government is sitting back while it happens. And it's not just commercial real estate where this is happening in. We had this story this week. Canada's 9 Point halts cash payouts on 3 of their credit funds. Now, this is, instead of commercial real estate, this is zombie companies that had been unable to borrow any more money since interest rates went up. The banks will no longer lend to these zombie companies because they haven't had positive free cash flow in 15 years. And so the financial system has created this behemoth of private credit, which is basically just, instead of banks loaning money, they dip into your pensions and they loan money to these zombie companies. So these private credit firms make loans to these zombie companies, and then this private credit fund is sold into pension funds. Well, these companies don't make money. And so what Canada's 9 Point is saying here, hey, since we're not making any interest payments here, nope, we're not getting any of the money back from these zombie firms, we have to halt cash payouts on these funds. And those cash payouts would go into your pension. And so these zombie companies, their debt is now being parked on pension plans. And you can see it even here in this article in pensionandinvestments.com or PI Online. Private credit attracts billions from U.S. pension funds. So the takeaway here, guys, what's really going on in this story is your pensions are being used as exit liquidity for zombie companies that can't afford to borrow money in these interest rate environments. So instead, they're borrowing from your pension, knowing they can't pay it back. And already these firms are starting to have trouble. The commercial real estate, which is still sitting on most regional banks and small banks across America, those banks are not revaluing that commercial real estate. Instead, they're selling it to your retirement plans, whether it's an IRA, a 401k, or a pension. And then once it's off of their books, then we find out how much money they're losing, like we saw in that article about the pension funds being clobbered. And in closing, I want to play a second video, another phone call that Michael Burry, portrayed by Christian Bale, had with the Goldman Sachs people, but it was later on in the movie. Listen to what happens in this call. Listening.
Dr. Berry?
Yeah.
D. Winston, Goldman Sachs. Listen, I've been reviewing your position. I wanted to discuss your marks, make sure they're fair.
Yeah, I think you mean that you've secured a net short position yourselves, so you're free to mark my swaps accurately for once, because it's now in your interest to do so.
I'm not sure what you want me to say.
I think you've already said it.
So where in the first phone call, Goldman Sachs is saying, oh, these are very complex financial instruments and they're not correlated and our system broke down and that's why we couldn't call you back. They weren't fairly valuing the value of Michael Burry's credit default swaps because it wasn't in their interest to do so. All the while they were lying about what those swaps were worth. They were unloading their toxic mortgage-backed security debt, and they were buying those credit default swaps themselves to protect themselves from the collapse. And so it wasn't until after the bank had unloaded all of its garbage to unsuspecting investors, then they called up Dr. Burry and said, now let's talk about what this stuff is really worth. And that's exactly what they're doing with commercial real estate and with private credit right now. They're lying about what the stuff is worth on their own books. They're selling it to your retirement, and we're not going to find out what it's really worth until the banks have gotten out of Dodge. And there's a reason for that. And there's a reason why the politicians are looking the other way right now. Bailing out banks is not very popular with the public. If we bail out Wall Street again like we did in 2008, the public will be up in arms. But who could possibly be against saving grandma's pension fund? If grandma's pension fund is going under and, oh my God, grandma's going to be left out in the cold, no politician will dare stand up and say, no, we shouldn't bail out these pension funds. And so what's going on right now, because the banks are being allowed to transfer this sludge into your retirements, is this is a bailout of the banks using your retirement as a conduit. Ultimately, they're going to park all this crap on your pension, then bail out your pension. And what's finally going to come out of it is going to be higher inflation because they'll bail out your pension by printing money and further inflating the asset bubble. And so while you're being distracted by the orange herring, right, Herringus magatus, keep in mind your nest egg is being robbed by the financial system and both parties are in on it.
Excellent. So I have a comment and kind of a question. So, what do we've noticed in the press probably 6 months ago, I believe they started talking about how, it was just the regionals, maybe it was a little bit longer, that were exposed to commercial real estate. And then we, kind of realized, oh no, of course, the big banks are exposed as well. In a way, the regionals kind of served as a distraction at first, right? These silly regionals that don't know what they're doing, they're clueless. But in reality, what I think that was a cover story for exactly what you're talking about. How can we, rehypothecate this risk out there? So what do you think? What do you think could be a potential trigger for these write downs to start actually showing up in a way like on these balance sheets?
So the trigger in The Big Short, if we're going to use that as the example, was when the banks were finally securing a net short position for themselves, right? When the banks had sold their mortgage-backed securities and they had bought credit default swaps. So now it's in the bank's interest to allow these things to go down in value. All right. So that will be the trigger when, and we're already seeing that this is in progress because, Bloomberg said the quiet part out loud, that risk is being transferred to investors and investors as pension funds. So, the trigger will be when it's finally in the bank's interests to allow that price discovery. And we're obviously still not there yet. And in the meantime, we have things like small regional banks as they fail, like we had Republic First Bank failed a few weeks ago. they're being bailed out in full. The uninsured depositors are being bailed out in full at the expense of the deposit insurance fund. Again, the losses are being socialized. And so that's buying them time so that the panic in the regional banks doesn't expedite this collapse. It gives them more time to unload this garbage and the unsuspecting investors. So, I can't tell you when it's going to be. I can tell you they're already in progress doing this. And so I would just recommend to people, if you're in a pension fund or if you're a union employee, get with your shop stewards and start squawking about this, start making noise. Hey, the people who are responsible for our money that we've trusted, are they being good stewards of our money? Start making noise about this, because they're distracting you over here with this trial, and meanwhile your nest egg is being stolen from you. And I think people need to know that, and people need to pay attention to that.
One other point I'd make, just kind of going along with that narrative and what I experienced while all this was happening, because, I was right in the middle of it. And my company actually was the redheaded stepchild that was used often in the press for being, the bad actor, because we were the non-bank theoretically, although we became a bank later because we had a small bank, but that's another story for another day. But, we were the redheaded subprime lender. In reality, we had a huge government book as well. And the reason why we did our write downs early was because Cerberus had purchased us at the top, and they wanted, and they realized it, and they wanted a purchase price adjustment. And so I would argue that in reality, the banks didn't get all the time they wanted, or we would have never seen Lehman. We would have never seen these things happen, Bear Stearns, et cetera. I would argue that there was an event like with my company where you just could no longer hide what was actually happening. And so that's kind of what I'm thinking about, on the lookout for, because I do believe we're going to get some kind of event here in the near future.
And Jack, I could just, I got a couple things for you. I want to reiterate some points that you made for the viewers, and then I want to direct questions to how people find out how their 401k is being spent. But just to reiterate, this is essentially, first of all, my feeling on what you just said is this: it's just the same old crap happening all over again. You have greed, corruption, fraud, the first to find the loopholes. And so we have all these loopholes again. And essentially what you're saying is okay, first of all, we have a CRE meltdown. We have a commercial property meltdown. We have vacancies. We have property values plummeting. And what you're saying is not only are teachers and firefighters paying for that bill, but there is an increase, a surge of 170%. So if there's any teachers and firefighters, and I know you're a volunteer firefighter, Jack, thank you. But also, how dare they? And so my question is this, Jack, and maybe you don't know this, and this is okay, but where do people go that have a 401k, whether they're retired or not, where can they go to make sure that type of investment risk is not happening? And then follow-up question is, if someone has an existing 401k right now, especially if they're retired, Jack, where can they go to their 401k statement to find out whether or not their money is being spent on these toxic assets?
So let me preface by saying I don't have that piece of paper from the government that gives me legal permission to tell people what to do with their retirements. So anything I say, as always, folks, consult with a professional. That's my CYA take there. They're very good at hiding this stuff. You might hear a portfolio manager, a fund manager, or a financial advisor saying, no, we don't have any commercial real estate. Don't worry, we haven't put you in that. No, you're in safe, you're in ETFs and mutual funds. Well, sometimes they can hide that within the prospectus, within the prospectus, within the prospectus. And what I'm saying is, the guy might tell you, don't worry, you don't have any commercial real estate, but you got to open up what you're actually in and look for phrases like income fund, right? And an income ETF or an income mutual fund. That usually means that they're parked in bonds and that they're out there chasing yield. They're looking for higher interest rates, and higher interest rates usually come with higher risk. And right now, commercial mortgage-backed securities is where you can get these higher interest rates. And over the years, a lot of these retirement funds have been kind of forced into this stuff because of the low interest rates, the ZIRP and BRRRR, the lower zero interest rate policy of the last decade. So a lot of funds were already in this stuff before this even started. But now, obviously, with the 170% increase, it's getting worse. You also want to look out for certain target date funds in the near futures. Like if you've got a target 2030 retirement fund, chances are, because that's so close in the future, you're probably in a heavier allocation of bonds, and you want to watch out for those. Within those funds, you're going to find a lot of these income ETFs and income mutual funds that are really targeted towards this kind of stuff. And of course, anything that says high yield in the name is almost certainly going to be buying this crap up as well. So, they use words that sound really nice: income ETF, high yield, target
Yeah.
retirement of 2030. And usually
But it's
those are like the
nonsense.
danger signs. Yeah.
And Jack, just for the sake of time, and I try to cut you short, I want to take a couple questions. We have our first guest here. Ulysses is here, so I want to get to him. But a couple good questions from the viewers. Here's one on the screen right here. You may not know this, but it states, will the state pension funds seek additional funds through taxpayers, through their workers, or both? Do you have an opinion there, Jack?
Yes, that's exactly what they're doing, right? They know they need to socialize the losses of these commercial buildings, right? The problem is so big. And of course, if we were to just bail it out right now, which I'm not a proponent of any bailouts, but to hammer everything looks like nails, and these Keynesians in the financial system, every time they screw up on a massive scale, socialize the losses is what they do. So their plan is going to be, first, move the debt from somewhere where you can't politically easily bail them out, the banks, move that to the pension funds, which is a very much protected class: teachers, firefighters, grandmas. Who could be opposed to bailing them out? You heathens, you don't care about throwing grandma off the cliff. When it comes time to bail out pension funds, those things will sail right through the legislatures unopposed, because nobody would dare stand in front of that and say, don't bail it out. So the key is, right now, while the risk is being put there, that is when the bailout is happening, even though they won't vote on it for many months. So absolutely,
Okay.
it'll sail right through those legislatures.
And last question, Jack, and then we'll move on to our next story here from Julius. Julius, I see you. Please stop calling me Ted Cruz. That hurts my feelings.
I'll bet.
But you started that whole thing, Jack.
I did.
It was a fair play. Are pension funds too big to fail? Why or why not?
I would say the pension funds are going to fail one way or another. All right. They're either going to have to default on some of their obligations, i.e., we made promises we can't afford, or they'll have to debase the currency and print money to bail out the pension funds, in which case, yeah, you'll get your dollars that you're owed, but those dollars are going to be worth a lot less than they were when they were promised to you. So one way or another, those pensions are going to fail, either by cutbacks to the payouts, or the payouts won't be worth spit when they finally happen. So,
all right, you guys. Well, that's a wrap. And big thank you to Jack for the story. Let us know how he did in the comment section. Share us your thoughts. And we're going to go ahead and move on to the next story now.